This is level 3 of the CFA program, the topic on asset allocation and related decisions in portfolio management, and the reading on an overview of asset allocation. You might have noticed that after the Institute introduces this third study session, it has 3 or 4 paragraphs that pretty much say that it believes, and professionals in general believe, that the asset allocation decision is the most important decision made in the investment management process. Now, this reading, an overview, really is a focus on governance. And I want you to think of governance as, kind of a formal organizational structure of decision making. Let me give you 2 quick examples. Let's suppose that I'm a high net worth client and I come to you and I say, here's $100 million of my dollars, do something with it. And you say, like, oh, you know what? How about if I put 80% in equities and 20% in fixed income securities? You've made what the Institute describes as the most important decision in the investment management process, but it's probably not according to the best practices of governance. No, of course not. What you need as a good wealth manager is you need the breadth and depth of knowledge, or you need to surround yourself with a team of experts who will fill in the gaps of your depth and your breadth. Remember, I say this pretty regularly. The Institute doesn't require us to be experts in every topic inside of the program, but they require us to know enough so that we can ask somebody, some expert, when we don't know the correct process or the correct procedure, or if we just need some help. You'll see that as we go through these learning outcome statements. So remember, the focus of this reading is on governance. So there you go. Very first LOS. Describe elements of an effective investment governance. And this is the first reading where we really dive into the policy statement. And we'll talk about the policy statement throughout level 3, but here we really start to focus on it. You might remember in those first handful of recordings in level 3, I had to kind of impose where those readings fit into the policy statement. And by the way, those last 2 recordings were super long. Hopefully you lived through those and you didn't fall asleep. These are a little bit shorter. So hopefully we'll have a lot of fun going through things like economic balance sheet. We'll talk about risk. We'll talk about risk factors. We'll talk about different kinds of asset allocations. We'll even have a beautiful picture of the Harry Markowitz efficient frontier towards the end. And then we'll talk about rebalancing at the end of this slide deck. All right, so let's start off with that first one. Describe elements of an effective investment governance. All right, so what does that mean? What did I say just earlier? It's an organizational framework to make decisions. Now notice in that very first line up there, these are made by individuals or groups of individuals with the necessary skills. This is what I was talking about earlier, if it's just you individually or you surround yourself with a team. All right, so common elements of an effective investment governance. All right, so let's go ahead and think about how this fits into the policy statement, and we'll see one of these elements is the actual policy statement. All right, so let's go back to my original example. I'm a high net worth investor. I come to you for advice. Now, before you decide on anything, you're going to ask me a series of questions. You remember in some of those earlier recordings, we talked about surveys and interviews and trying to determine risk tolerance. So what we're going to do is you and I are going to figure out what my short-term objectives are and what my long-term objectives are. Now, I may have some idea of what my objectives are, but if I say something like, well, I have 2 children there in the 7th and 5th grade, and I want to make certain that I can pay for them to go to an Ivy League school, when they reach college age. All right, so that's pay for college education funding. Well, I know what that is, but you as a good wealth manager, you're going to have a lot of ideas about how to achieve that goal. So articulation of long and short-term objectives. Then your responsibility is to decide on who has the rights and responsibilities among what the Institute calls the units of governance. So that you could be the entire unit, but it's likely that you're going to have either either equally weighted team members or, support analysts or support staff. And so you're going to say something like, oh, over there, Ted, I want you to be responsible for alternative investments. And you say, oh, you, Becky, this is a high net worth client. Sooner or later, Jim is going to come to us and say that he wants to invest in a call option. So you're going to be the expert on derivatives. All right, does that make sense? Assign and allocate those responsibilities. And then in this third element, we're really going to get into the concept of this policy statement. Specify the process for developing and improving the policy statement. Remember that this is the heart and soul of this investment process, and it outlines, maybe even in an informal way, the contractual obligations of both parties. Not just the parties of you as the wealth manager, but what I'm responsible for doing. I'm responsible for providing you with updated information, provided you with my financial statements, with my income and all that kind of stuff. And so we'll go ahead and specify that process. And that process can be fairly simple or it can be relatively complex, depending on, going back to that first element, what are my long and short-term objectives? How many dependents do I have, whether they are children, whether they are my own parents or grandparents that I want to take care of, or a niece or a nephew. And then go ahead and complexify all of this. If I'm not a high net worth investor, suppose I'm a pension fund manager, or I run an endowment fund. Think about all the extra complexities associated with those institutional investors. And by the way, we'll talk at length about individual and institutional investors as we move through level 3. All right, 4. This is essentially what the heart of this reading is: identifying the process for developing the strategic asset allocation. So remember, the strategic asset allocation is going to be the allocation between and among, let's just pick some standard ones, a little bit of cash, equity securities, fixed income securities, and let's just lump everything else into alternative investments. This strategic asset allocation is going to be the focus on our reaching those long-term objectives. However, I need to put a comma there after that sentence, not a period. I put the comma, and after the comma is going to be a sentence that sounds like keeping in mind what our short-term objectives might be. And then, of course, the fifth element is what the Institute loves to do in almost all of the processes that it teaches us in level 1 and 2 and 3. We need to monitor, right? So a framework for monitoring. How are we going to monitor the process? How are we going to monitor the decisions? How are we going to evaluate the decisions? And then how are we going to improve on our mistakes? Because remember, we're trying to predict the future here, and we're never going to be able to predict it with 100% accuracy. So we're going to make these strategic asset allocation decisions with some degree of error. And we need to be willing to accept those errors. And that's part of this specifying the process and the responsibilities, that the client is aware that, hey, you know what, we may deviate from this at some point. And then finally, we need to pick up the phone and call somebody over there, third party, preferably, to audit our governance model. All right, how about if we articulate our investment objectives and constraints? All right, so if I'm Jim, I'm this high net worth investor. And after you interview me and gather all of my financial information, and we talk about my short and long-term objectives, you're going to put together some math, and you're going to have a return objective. Let's just say it's 10%. By the way, that 10% will include a measure of inflation. I'm not quite sure how wealth managers are incorporating an 8% inflation rate into the return objective in 2022, but somehow they are. And then we need to flip side that. What about a risk objective? We'll learn, not in this reading, but in future readings, that we need to be concerned with an investor's willingness to take risk and an investor's ability to take risk. And what we need to do is make sure that we come up with some kind of a math result. That's what articulating the investment objectives means. All right. So what did I say earlier? We'll have a 10% return objective, and then maybe I'll have a 20% standard deviation risk objective. Now, the Institute is not going to force us to pick standard deviation as our risk measure. In fact, it's probably against forcing us to do anything like that. I mean, it might be beta, it might be value at risk, but it might be just as simple as saying, all right, on a scale of 1 to 5, this client has 3 level of a risk objective. Maybe we'll just call that moderate risk tolerance. Now, of course, we need to worry about individual investors there on the bottom left. We need to worry about institutional investors in the middle and on the right. And I will make the following comment that in some of these early paragraphs, the Institute makes a comment that while there are lots and lots of institutional investors, the focus of many of the examples inside of this chapter are on pension funds. So you'll probably see that and hear it throughout the reading and throughout this slide deck. Yeah, varying investment objectives. All right, so what kind of individual investor objectives might there be? Retirement, what did I say earlier? Paying for children's education, maybe buying a vacation house, beach house, a lake house, something like that. Endowment fund, they're going to have a return objective that is probably going to exceed, whatever kind of a hurdle rate or whatever the required fund return is, in line with the distribution of the fund's mission. So you guys ever watch Seinfeld? Some of you are too young to do this. One time George made up a fund called the Human Fund. And we have no idea what the Human Fund is, but I'll just go ahead and say something like, okay, here's an endowment fund that is designed to benefit humanity. And maybe the board comes up with the idea that, hey, you know what? We want to distribute 10% of the value of the fund, comma, or parentheses, including dividends and capital gains, to humanity, whatever that means, it's one of those silly Seinfeld things, so this rate of return depends on, what the board decides and what is the mission. Pension fund, on the other hand, they don't have nearly the flexibility that an endowment fund has, right? George and the Human Fund on Seinfeld, they can do whatever they want with that money, but a pension fund, they are legally and contractually obligated to not only pay for the current retirees' benefits, but also to fund all of those future ones. So what does that say over in the far right? For plan assets to meet current and future plan liabilities. All right, now back here, let me go back here. Notice in the blue, articulate investment objectives. There we did that here on this slide. Now we'll move to the constraints. And the Institute believes that there are 5 investment constraints. There they are. I will say this, and this might help you on the exam. When I do this in both my graduate and undergraduate investments class, I have my students do 6 investment constraints. And what I do is I require them to have an emotional bias and cognitive error for their individual clients. So I have a separate behavioral finance constraint. But what you should be aware of is that the Institute wants you to just throw that into the other unique circumstance constraints. So you have a tax constraint, of course. What does that mean? Individuals and some institutions pay taxes. For an individual, you also have to worry about things like property tax if they own a home. You have to worry about capital gains tax. You have to worry about estate tax. Time horizon, this is probably broken down into stages. Maybe I'm 61 years old, so I'm probably going to work for another 6 to 40 years, right? Teaching, let's say 6 to 8 years. So there's my, remaining work time, and then probably active retirement, 68 to 72 or something, and then 72 to death, maybe passive retirement and estate planning, legal and regulatory restrictions, and then liquidity liquidity events, these are typically one-time lump sum events. So think about this example that, you have a client who wants to buy an electric vehicle for $125,000 in the next 6 months. That would be some kind of a liquidity constraint. And then anything that doesn't fit into those four initial categories, like a behavioral issue, will go into the unique circumstance constraints. All right, this is what I was saying earlier about this allocation. So you have investment staff, you have your investment committee, and then you have third-party resources. So clearly defined, sponsoring funds should be willing to invest in the appropriate level of talent, right? So that means that you should have some kind of financial support in putting together your staff. All right, here's the policy statement, the actual policy statement. Notice what the Institute calls this the foundational document that explicitly, and that's really important, in the policy statement, there's not going to be a sentence that says something like, oh, and the wealth manager can do whatever he or she wants. There's probably going to be very specific guidelines about how the funds will be managed and the reasons why. And of course, this is a great exam question. The reasons why, here, let me just go back here quickly. The reasons why are going to tie back into the risk and the return objective, and that should make perfect sense. Created at the outset of a portfolio management relationship. I'm going to go ahead and make another silly comment here. That's a word that the Institute uses, the outset. A lot of people use that word outset, but the word onset also means at the beginning. So the outset and the onset, they both mean the beginning of some process. I have no idea how those two words can mean the same thing. Out and on, they don't mean the same thing. Updated regularly over time. You know this from listening to my recordings, level 2 and level 1, that is super important, and the Institute emphasizes this, that you cannot put together a policy statement today and then let it go for years and years before you revisit it. So updated regularly over time, at least annually, but then, probably some kind of an informal reach out between you and the client, during the course of the year. Look at this, most crucial steps. So let me just go back here. What was I saying? So here are some of these elements. And so the Institute is saying this policy statement is the most crucial step. So the strategic asset allocation is developed after we figure out those risk and return objectives. We figure out all of those constraints. And then we do some simulation, and then we attribute risk and return and figure out exactly how we're going to achieve those risk and return objectives. Yeah, how are we going to rebalance here? So calendar rebalancing, I was saying that annual as part of the monitoring and the updating, or you can set percentage deviation thresholds. And this is really kind of an interesting model because, if you do this every year, that's probably sufficient, but the Institute would probably prefer you saying something like, we're going to monitor this throughout the year, monthly, let's say. And if those values of each asset class changes by 1 or 2 or 3 standard deviations, we ought to know about it and we ought to talk about it and decide what we're going to do about that. Reporting framework, this is super easy. Evaluation, we're going to make sure we're compliant and we're going to make sure that we're maintaining progress toward those goals. Where are we now? What value has been added or subtracted by management decisions? This is where you're going to do this attribution analysis, right? Security selection and asset allocation. That's a simple model that we've talked about before, but that's a key part of determining where we added value or subtracted value. And then what about those goals and objectives? And remember, this is a dynamic process. So the goals that, what did I say earlier for me, were maybe 10%, by the end of the year, I may be changing and say, I only need 9% or I need 11%, so you got to consider the dynamics of the risk and return framework. All right, how about the audit here? Independent third party, I said that earlier. Unbiased, yep, so you need to make certain that as an independent third party, and they'll probably be able to give some kind of an unbiased report, thorough review of the documents, and then a performance appraisal of the team. And that appraisal is going to include an evaluation of the process, and then an evaluation of the decisions, right? So the process could have been really, really good. We did this and this and this and this. We did all this stuff, but we still stunk at the end of the year. Why did we stink at the end of the year? So we need to swing back to those risk and return objectives. Of course, on the other hand, we could have shown as a superstar at the end of the year. Look at that diamond point at the bottom. A good governance system can help reduce decision reversal risk. This is something that's really interesting, and it relates back to what we did in those earlier two readings on behavioral finance. So let's suppose that our client required 10%. And during the course of the year, we have things like COVID and we have things like inflation. And so the value of the portfolio is falling and falling. What are we tempted to do? We're tempted to say something like, boy, let me try to get that money back. Let me do this tactical decision to try to do this. So that's what the Institute is trying to get us to avoid. Sticking with our strategic asset allocation, being adults in the room and saying, look, here's the choppy waters. We're always going to have choppy waters. And this is part of the process of educating the client. And I'm a big believer in history. And so you can say to the client, look, we had a crash in 1929. We had recessions after World War II. We had recessions in the 60s. We had a spike in oil prices in the 70s. We had a crash in 1980. I could go on and on all the way through this 2022 inflation. So you convince the client that, look, there are going to be calmer waters ahead. We need to make sure that we focus on that long term. So look what we have in bolded there, precisely at the costliest moment. All right, let's move to this concept of an economic balance sheet. So we spent lots of time, especially back in level 1, on a financial balance sheet where we had assets and liabilities and equity. But now let's extend that to what the Institute calls an economic balance sheet. And this includes extended assets and liabilities. So look at individuals. What are extended portfolio assets? Human capital, right? So my brain, present value of pension income, present value of expected inheritances. Now, I'm guessing that if the Institute asks this question on the exam, they'll go ahead and have something in the fact pattern that says, oh, the client has read the will of Uncle Ed, who's on his deathbed, and the will says that the client is going to get $10 million. All right, so let's go ahead and probably agree that the Institute will give us probably a relatively certain, not like my father. My father, he lived after his diagnosis for about 5 months. And so he would tell my sister and I, depending on what we did for him, oh, you're going to get the bulk of my estate. And it was funny because my father was, a very humble man and had a humble background as a high school educator. In fact, when in the last days of his life, I made him some scrambled eggs. And as he was eating the scrambled eggs, he said, son, I think your sister's getting all of my money because these are the worst scrambled eggs that I ever had. Of course, he was, joking, and he taught us great lessons there. So my point is that you probably won't have uncertainty about expected inheritances. How about extended portfolio liabilities for individual investors? Present value of future consumption. So this is really related to what I was saying earlier about the liquidity constraint. What did I say? We want to buy a beach house or a lake house. Well, if we want to do that in the next 6 months, we'll probably just take that out of our investable assets and put it in treasury securities, and not worry about it. So in 6 months, we can go ahead and buy that house. But if we want to buy the beach house in 10 years or 20 years or something that we want to retire to, well, then we'll go ahead and take that as a present value. Future consumption of, a substantial purchase. Institutional investors These extended portfolio assets, I like the second one there, present value of intellectual property royalties. So that's probably difficult to estimate. And so I'm guessing that the Institute would just come up with a number on the exam. In fact, if you look at the end of reading problem, there's only one. It's a question stem, and there are eight questions after the fact pattern and the vignette. And they do ask about intellectual property royalties in there. Underground mineral resources, I guess this could include all different sorts of things, but I'm wondering what this means with ESG investing, especially with fracking and oil. So, but you can include those for institutional investors. Present value of prospective payouts for foundations. So going back to, what did I say earlier, George Costanza and the human fund, I mean, maybe they're going to say something like, in 10 years we want to do something. So you would include that in there. Here's just a quick example of an individual's economic balance sheet. So up at the top, you have just regular old financial assets and liabilities. Then we have present value of future earnings, present value of expected future consumption. So there's that total wealth from the economic balance sheet. What is that? 4.2 million in assets, 4.2 million in liabilities, and economic net worth. So what's that number? 2.4 million in economic net worth. Notice the LOS says to prepare, and one of the questions at the end of the reading is to go ahead and give that number, the 2.441 million. So I would make sure you can do that. That prepare means to compute. When I first looked at this illustration, I thought, boy, this doesn't really apply to me. Look at this. So you got age, human capital. So I'm almost at the end there, right? I'm 61 years old, but I feel like I'm a way better professor than I was 20 years ago. And I have 10 years left in me. I don't want to be way down there. And financial capital, I'm just the opposite. I have 2 more children to get through college and start their careers. I have 1 child who's just starting his career. So this doesn't apply to me, although it probably does. So let's go ahead and just agree that this is a good slide, a good illustration for the average investor. All right, how about approaches to asset allocation? So this is one of the more important LOSs as I see it inside of this reading. All right, the asset-only approach. It's exactly what the name suggests. We're only looking at the investor's balance sheet. We're not really worried about the liabilities over on the right-hand side. What we're going to do is we're going to go way back in time to 1952 and Harry Markowitz. We're going to use our mean variance optimization, and that's based on expected returns. It's based on standard deviations, and it's based on correlations between and among the assets in our portfolio. Let me go ahead and just remind you, I've said this to you before, those of you who love Excel, you can find the optimal mean variance portfolio in Excel using solver after you use the sum product function of stock returns. Ultimate goal, maximizing Sharpe ratio. We've talked about Sharpe ratio for a long, long time, going back to the beginning of level 1. So I shouldn't have to remind you of what that Sharpe ratio is. All right, how about liability-relative investing? Well, this sounds an awful lot like, hey, this is probably appropriate for a pension fund, right? What did I say earlier? The pension fund manager has to meet all of those obligations on time, and there's probably some legalities there associated with it. What this means then for us as good wealth managers is that we have a surplus, right? Assets minus the present value of the assets minus the present value of the liabilities. There's a surplus in there. So we can put together some kind of a model to optimize that surplus so that we can, grow the fund while meeting those obligations. Now, I keep telling you guys to read the Wall Street Journal regularly. I hope you do. And you should read about in the United States, state pension funds do not tend to have surpluses there. So I have no idea how those managers are doing this when they have deficits. And how about goals-based investing? This is what I was talking about with me. I'm the high net worth investor, used for individuals and families, lifestyle goals. There might be a strategic asset allocation for each goal, like the college education and maybe retirement. And that might mean we have sub-portfolios inside of the asset allocation. So what's the difference between these last two? Liabilities of the individual versus the liabilities of the institution. Lifestyle goals, meaning those legal obligations. It's probably not easy to predict those, and it's probably super easy to predict those pension payouts. So look for those differences here to meet this compare LOS. Yeah, here's one of those slides where I'm going to ask you to get out your phone and take a picture of it. So here's our three approaches: asset only, liability driven, and goals based. So there's the orientation, there's a typical objective and a typical investor. And so I can envision a vignette in which somewhere in there you're told, hey, here's a financial institution, and there's a bunch of other stuff. And one of the questions, question 4, says, this is most appropriate for, and you would say a bank. All right, how about contrast the concept of risk, all right, relative to those three goals? All right, so the asset-only approach. So what are we doing here with the risks? We need to figure out the risks of each asset class, and we're going to construct effective asset class combinations. And of course, we're doing that within the context of this mean variance optimization. And so what did Harry Markowitz teach us back in 1952? That essentially what he's doing is he's trying to find the optimal combination, the optimal locus of points, right, that minimizes risk while maximizing expected return. So that initial Harry Markowitz model was standard deviation, or variances, right, however you want to look at it, and correlation coefficient, or covariances if you want to think of it that way. But there are other ways for this mean variance asset allocation. You can apply these things and come up with things like a tracking error. You can do semi-variance. You can do value at risk. And then, of course, if you have tons of computing capacity, you can do Monte Carlo simulations, which I think are just super fascinating, and you can draw all those, all of those thousands and tens of thousands of, what might be nearly normal distributions, and you can come up with some average. So I love Monte Carlo simulations. So remember, you can do all this stuff in that asset-only approach. But with the liability approach, what you're concerned about mostly is, all right, I have $100 and I have $90 in an obligation coming due this week, right? So, all right, that sounds okay. But suppose I have $100 and I have $110 in obligations. So that brings in the specter of shortfall risk. We talked at length about shortfall risk back in a little bit in level 1 and again in level 2. Remember, I said earlier that if we have a surplus, then we're going to optimally manage that surplus. And so what we want is the standard deviation of that surplus. How about the risk associated with goal-based approaches? So risk of not achieving the stated financial goals. I mean, that should be an obvious one. If we decide that I have a 10% return objective as a high net worth investor, and part of that 10% is my living expenses so that I can travel to see my grandchildren in Canada. And you come back at the end of the year and say, oh, Jim, I only have 8%. You can't, if you're going to go to Canada, you're going to have to walk. And I'm going to say, boy, I'm not really happy about that. So risk of not achieving the stated financial goals. And so make sure that you are aware, and a question stem, the reality, the humanity of missing those stated financial goals. Yeah, multiple time periods, so that's important. Portfolio risk, the weighted sum of the risks associated with each goal. That's kind of like a Harry Markowitz application there. Maximum accepted probability of not achieving a goal. Yeah, in my experience in talking to individual investors, maximum acceptable probability of not achieving a goal most of the time is 0%. All right, how about super asset classes? All right, an asset class is a group of assets which all share some common element. But here, let's talk about this broad class. So capital assets, consumables, and a store of value. All right, so we know what these capital assets are. Equities and fixed income securities. They produce a regular cash flow. That could mean probably dividends and interest income. Consumable and transformable assets, oil, timber, precious metals. When I have my students in the undergraduate class craft their policy statement, I have them create a fictional client, and I force them to come up with one of these consumable or transformable assets. And so one of the common sentences that I read in these is that the client has an uncle from Texas, and this uncle has an oil well in his backyard, and he's getting ready to die, and the client inherits that oil well. So I tell you that story just to link back to those expected inheritances that we talked about earlier. Store of value, currency. Not sure what that means in terms of the US dollar in 2020 with 8 or 10% rate of inflation. But of course, currency, art, and collectibles. I think I've told you the story about art. Those of you who are Steve Martin fans, Steve Martin paid a couple $100,000 for a piece of artwork, and it turned out to be a forgery. And he, of course, responded in his truly comic reaction like he always did. Super funny guy. All right, how about criteria for specifying an asset class? All right, we probably know this. Relatively homogeneous. They should be mutually exclusive, meaning that a fixed income security probably doesn't belong as a collectible, right? And asset classes should be diversified. A preponderance of world investable wealth, right? No asset should be left out. You'll see this here in an illustration in a graph in just a few minutes. Maybe we can select asset classes based on their transaction costs and their liquidity costs. Public equity, yeah, New York Stock Exchange, we know that. Private equity, we've talked at length about this all the time. Global fixed income, real assets. I think that apartment buildings and other types of real estate investments that generate regular income, they make for really, really good vignettes. Domestic equities, fixed income, cash, and alternative investments. Yeah, that makes sense. So we'll probably have some subcategories. So let's do this just quickly, right? Equity and debt. So we have U.S. and non-U.S. And then we divide it up into size. And you can continue to divide these up however you want. But the sub-asset class level, didn't we talk about these sub-levels in a previous slide? Emerging markets and developed markets, small cap and large cap. You could throw mid cap in there. You could throw micro cap in there. How about common risk factors in these asset allocations? So going back here, if we invest in a fixed income security in the U.S., I'm over on that right-hand side, and if they are investment grade, so remember investment grade, that's BBB rated bonds or above, are there overlapping risk factors, right? Well, if we have one of those, what did I say here? Investment grade U.S. bonds, well, that could be, we could have a AAA rated bond that's 1 year to maturity, and we could have a 10-year BBB rated bond. Sorry, so the durations of those two are different. The convexity of those two are different, and their default risk is different, right? So we have these overlapping risk factors that may pose a hurdle. And then we may have factors that are going to pose some extra hurdle. So we spent some good time back in level 2 talking about factor exposures. And so let me take the relevant one. Look in the bottom second one, inflation. Let's suppose that we develop this factor model. And by the way, these factor models, essentially what they do is they'll take a sample of stocks. Let's just suppose that we have 30 stocks in the Dow. And we go and we collect stock returns for them over the past year, daily returns, whatever it is. And then we divide those into performance over the last year, depending on their reaction to the monthly rate of change in inflation, right? Every month we hear about inflation. And so what we do is we have 30 stocks, so we have 12 months. And so what we do is we aggregate them and we rank them. And so, some of these stocks, when inflation goes up, they react really poorly. When inflation goes up, some stocks don't react poorly at all. Maybe they react positively, right? So these are those factor exposures. And essentially those factor models rank them. So if you want lots of exposure to inflation, you take the top end. If you want no exposure to inflation, you take the bottom end. And so you see how this works here. So we're going to allocate something to a factor like inflation or volatility or liquidity or any of these other kinds of factors. And these are the factors that the reading mentions. So it's probably important to remember those. What are those 10 factors? How about utility maximization? So this goes back to what we learned in our economics days. So what do we want to do? We want to provide an asset allocation and, by the way, probably an entire policy statement according to the client's utility. We want to maximize the utility. Remember, utility in economics is just a fancy term for satisfaction. So look in the orange box, investors' risk, return, and investment constraints. All right, so think about that orange circle. Did I call that a box just a second ago? That orange circle as the result of the interview and an evaluation of the client's goals and fears and aspirations. Plus, we'll couple that with all the work we just did in those 2 very long readings and 2 long recordings on capital market expectations, and then we'll come up with a strategic asset allocation. Now, notice that strategic asset allocation, right above it, we have bolded tactical allocation measures. So inside of that strategic allocation, and this is what I try to tell my students, if we're going to say something like, all right, we have a client and we want that client to have 60% equities. 60%, that's pretty dangerous because, stock values change every day. So my preference, and the Institute, tends to do this over time and in other readings, that we're going to say something like, let's have a window. Let's say, hey, 55% to 65% is the strategic allocation to equities. What that range does is it allows for just kind of natural fluctuations, but it also allows us to tactically go in there and say, okay, let's suppose that because of whatever happens in the market, we're up to 63%. And we're thinking, okay, we're in that range, but I think some of these things are overvalued. I'm going to switch back to 56% and put some of that fund over into fixed income because I think interest rates are going to fall and these bonds are positioned with their duration to have, great capital gains. So you see the link here between, what that short-term objective and what the long-term objective is as it relates to the investor's utility, right? We want to provide that highest utility over that time horizon. And so, as always, the Institute, like me as a good professor, I always like to throw some math in there. And what the Institute does in this very short section that addresses this LOS is throws a formula at you. The good news, for those of you who are less mathematically inclined, which I hope is not too many of you after passing level 2, right? Tons of math in level 2. Here's a little equation that gives us the optimal weight in the risky asset if we're choosing between just the risky asset and a risk-free asset. And so I want to just take a moment here to work through this formula so that you understand how to select and justify based on a degree of risk aversion. All right, so here's the weight in the risky asset. So what are our choices? We could have 0% or we could have 100% or anything in between in the risky asset. So just think of the risky asset as, the S&P 500 index. So what are we doing? We're going to take 1 over lambda, and that's the investor's degree of risk aversion. And remember when we did this back in one of our economics days, I probably said this to you in a previous recording. If I didn't, I'll go ahead and say it now. That, degrees of risk aversion, people generally think they're probably between 1 and 10. So let's just pick a 10 just so we can do the math easily. So we're already starting off, if we have a high degree of risk aversion, that's 1/10, right? So that would just be 10% in the risky asset, which leaves 90% in the risk-free asset. But what we're going to do is we're going to adjust that 1/10 based on, well, inside of those parentheses, that's almost like a measure of our client's risk and return objective, right? We take our expected return there, that's the mu, minus the risk-free return in the numerator. So what do we want? We want lots of numerator. And then what do we want? We have the variance in the denominator. So let me just pick some simple numbers here. Suppose the return on the risky asset is 15% and the risk-free return is 5. So we have 15 minus 5 in the numerator, that's 10. And let's suppose the variance is 5%, just to do easy math. So 5 goes in there twice. So 2 times 10% is 20% of our weight in the risky asset. And that little math example that I just went through gives you an ability to select and justify based on investors' degree of risk aversion and, the client's preferences there. I don't think you'll have to do the math, especially in the reading. There is no math in this short example, but the implications are just fascinating here. So right after, here, let me go back quickly. Right after this equation in the reading, they work through these 9-step process for asset allocation. All right, so you probably know all this from what we've talked about here in the last 30 minutes or so. Ready? Determine and quantify. There we go. I was saying this earlier. You're going to quantify the return objective, 10%, and you're going to quantify the risk objective. Maybe it's standard deviation, 20%, or maybe it's just some kind of a range, moderate or moderate to high. Determine the investor's risk tolerance, how risk should be expressed and measured, right? Determine the investment horizon, and there's probably going to be some stages in there. This is what I said to you earlier. Whatever kind of constraints are there, including behavioral issues. Now, the Institute doesn't mention that in this reading, but sooner or later, there's going to be a combination of the behavioral issues thrown into that unique circumstance constraint. Determine the best approach to asset allocation. We've been through this, right? Asset, liability, or goals-based. Specify the asset classes. Develop a potential range of asset allocation choices. And we're going to do that through, our Harry Markowitz stuff, maybe Monte Carlo. And then we're going to test the robustness. Robustness simply means that, okay, we made a decision under these sets of circumstances and assumptions, and what are the results if we do something else over here, right? Robustness. And then we're going to develop another range of potential and then repeat that. And finally, once we're satisfied, we're going to put all this stuff into the policy statement. Now, I did mention just a few minutes ago, we'll get back to this illustration of Harry Markowitz. So there we are. Let's go ahead and look on the right-hand illustration. So the blue locus of points, so that's the Harry Markowitz efficient frontier. That was from 1952. Remember, Harry Markowitz is telling us that the best way to find an optimal portfolio is to find those securities that have low or negative correlation coefficients, right? And so Harry Markowitz, he does this minimizing standard deviation while trying to maximize expected return at each given level of standard deviation. Then what we did is that we ask ourselves the question, okay, if we found the efficient frontier, let's add a risk-free security to that risky equity portfolio. And that's the intercepting point over there on the vertical axis. And then if we draw a tangent line to that efficient frontier, we get what's known as the capital market line. And essentially, the capital market line becomes the new efficient frontier in the presence of a risk-free asset. All right, so what are we doing here? What is this global market portfolio, this GMP? That's the M in the middle. There's our global market portfolio. And I want you to think of it as a portfolio that contains one share of stock of every company that's out there in the entire world. Plus, notice that third arrow point there consists of all investable assets. So it includes all the bonds out there. Most diversified portfolio. So remember what we talked about in that Fisher separation theorem. Now, this is not part of the reading here, but I'm going to go ahead and add it to it. That Fisher separation theorem tells us that everyone's going to hold the market portfolio, in this case, the global market portfolio. And then we're either going to lend money to the government, the lending portfolio going to the left on the line, or the borrowing portfolio going on up and to the right of the line. We'll use margins, et cetera, et cetera. All right, so let's go ahead and talk a little bit more about this global market portfolio. All right. Start with an asset allocation in proportion to the global market portfolio of bonds, stocks, and other kinds of assets. Dismantle each asset into a region, into a country, and security weights, right? Using market value weights. So what this is going to do is this is going to simplify our life. Half equity, half to the risk-free asset, right? Simplify our life. Then, and let me go back here, to go to the lending portfolio on the left side and the borrowing portfolio up on the right side, look at what we've written there in that second arrow point. To deviate from the global market portfolio, an analyst would need to articulate an argument as to why it was justified. And that makes perfect sense because it might be justified because our client doesn't like risk. We go down towards the left. Our client might love risk, so we go out and to the right. Yeah, non-public assets, hard to estimate. We've talked about that before. Residential real estate, difficult to simulate. We talked about that before. Certain investments, such as commercial real estate, might be too large to replicate. All right, we know this slide here, passive versus active management. Stick to a strategic asset allocation. Do nothing or buy and hold strategy. Active management, on the other hand, we're going to make periodic adjustments. What are those periodic adjustments? At least annually, right? We've talked about that before, but maybe if there's a life-changing event or if we're an institution and the surplus increases or decreases, some dramatic change in our model. All right, so how about other strategic implementation choices here? All right. How about if we allocate some of our capital to IPS permissible asset classes? All right, so what we're going to do is we're going to say something like, equities and fixed income, but let's go ahead and surf. Think we're in the ocean on a surfboard, and we're going to surf over there to alternative investments, or maybe artwork from some emerging market artist. It could be almost anything. Tactical asset allocation, we've talked about this before. Short-term deviations, trying to improve risk-adjusted returns. And this is where the analyst is able to take advantage of those pockets of inefficiencies that we talked about in the behavioral readings to increase the risk-adjusted return based on the short term, right? We find overvalued securities and we find undervalued securities. Now, dynamic asset allocation, dynamic, that term means, kind of always changing. We don't want to change our allocation every day, right? We want to have this strategic asset allocation, but we may change those dynamics based on capital market expectations over the long term rather than the short term. All right, here we go again about behavioral issues. Do we believe that the stock market is at least semi-strong form efficient? Do we believe it's strong form efficient? Well, this is what I was saying just in that previous slide. There are pockets of inefficiency. But if you believe, and I believe, that markets are strong form efficient, then what does that mean? Prices reflect all relevant information, including private information. So we'll probably steer that away from active management. So look at the sentence look for a sentence in the question stem that sounds like, hey, here's Ed. He's an investor and he firmly believes that the stock market is strong form efficient. Well, then passive investing and a passive asset allocation strategy is probably relevant. Oh boy, I do this all the time, right? Marginal costs, marginal benefits. So active management has costs, right? And it has benefits. So we need to go ahead back to our microeconomics days and say, all right, let's decide. Do we get incrementally more out of this active management than it costs us? And then we'll go ahead and do it. Of course, that makes perfect sense. And we do this as well in the tax arena because, what are we trying to do? We're trying to minimize tax obligation of our clients, which means we're trying to avoid paying any unnecessary taxes. And so we need to make sure that we're aware of tax status. How about risk budgeting here? This is cool. We have risk metrics. What are we going to decide is our relevant and our appropriate way of measuring risk? Is it standard deviation? Is it value at risk? Is it exposure? Whatever it is, we're going to be required to educate the client that we're never going to be able to eliminate all risks. But what we want to do is, are you ready for this? I've said this to you many, many times before. I think this is the first time I've said it in our Level 3 recordings. Identify the risks, quantify the risks, and then monitor the risks. If we do that, we can use that as part of our asset allocation tool. So this risk budgeting is going to force us to focus on risk so that we can, how about if I just say it this way? We can focus on those factors, inflation and momentum, those factors that we had up there. Those are kind of risk factors, and this completes kind of our discussion. Rebalancing, of course, we know about rebalancing. When are we going to do this? Calendar, range-based balancing. We talked about that before. So here's a good final slide on strategic consideration. So what factors are important? Transaction costs, risk aversion, correlation, momentum, mean reversion, liquidity, derivatives, taxes. All right, so we have all these factors over here, and here are the implications about acceptable rebalancing. So take your phone out, take a picture of this. Look at that last sentence down there. Rebalancing has way more to do with risk control than it does with return seeking. That's probably a good sentence to remember. And that takes us through this reading on asset allocation and what we've done. Remember, this reading is called an overview. So we have two more readings here that we're going to get more into the granularity and the details. But what we've done here is we've pretty much built a good foundation upon which we can build to make certain that the policy statement is more complete. That's the goal here, to have this. What did I say earlier? That, governance is that, an organizational model of decision making. So we're building this model so that we can make the right decision for our clients. Hey, thanks for watching and good luck studying. Go ahead and quickly look at that 8-question vignette at the end of the reading. Have a great day.